The 6 months to the end of March was a positive period of absolute returns for Lowland. The NAV rose 7.1%. That lagged our FTSE All-Share benchmark, which rose 8.9%. And the reason for that was that this was a 6-month period where the FTSE 100, the largest companies in the UK, returned almost 10%, while the FTSE 250, the FTSE Small Cap and AIM indices all fell during the period. So there was a really strong divergence in how large, medium and smaller companies did. Turning to what drove the performance for Lowland specifically, 7 of the 10 largest absolute contributors to performance were those largest FTSE 100 companies. And if we look specifically at what did well, the likes of BP and Shell performed well in the period, driven by the rise in the oil price, while the likes of HSBC and Rio Tinto also performed well. Some of the smaller companies that performed well during the 6-month period included Serica Energy, which is a North Sea oil and gas producer, which benefited from the recent rise in energy prices. There was also continued takeover activity in the portfolio, with the likes of Senior, which is an aerospace component supplier, and fund manager Schroders both agreeing to bids. If we now look at some of the weaker performers during the 6 months, a period of subdued domestic UK economic activity, particularly in consumer-facing areas ahead of the November budget, so the likes of Dunelm and Card Factory were among the detractors because they were affected by that more cautious consumer behaviour. Elsewhere, the debate in the market ahead of the war in the Middle East was really around AI disintermediation and disruption. And the likes of software and data services companies saw their share prices fall, in some cases very materially. That's not a sector or an exposure that Lowland has materially, but it did see some share price falls in the area. So for example, Eleco, which is a software provider to the construction industry, saw its share prices derate, as did FRP Advisory, which is a restructuring services provider. In both cases, you didn't see any deterioration in underlying trading, but the shares did fall because of that worry around disintermediation. Both of those providers, so Eleco and FRP, they're quite specific in what they're producing. There's a lot of regulatory aspect to what they do. We think they will be relatively insulated, but time will tell. Turning now to transactions during the 6-month period, we think given that underperformance of smaller companies, it is throwing up some interesting valuation opportunities for us. And this is allowing us to buy some good quality companies at what we think are some pretty attractive valuations. So one example of that would be Cohort, which is a specialist technology provider to the defence industry, both to the UK, but also to overseas. So it supplies the likes of Rheinmetall, but also overseas navies like Italy and Portugal. Within the larger companies, we did add a new holding in RELX, which we haven't held in Lowland for several years. If we think back to February and that really severe debate that we saw around AI disintermediation, RELX saw its shares fall materially during that period, and we thought that provided a good entry point to what remains, we think, a very good quality and resilient business. We also added to some holdings in commercial property, and these were quite long-standing holdings within the fund, so this is the likes of Hammerson in the UK retail space and Segro in logistics, where they're trading at substantial discounts to NAV for what we think are really good quality assets. In terms of the main sales during the period, these were often driven by takeovers, so the likes of Renault, which was in industrial chains, and Schroders, which is a fund manager. Both of those positions were sold during the period. If we think ahead, there's so much uncertainty in the global economy at the moment, and we think now isn't the right time to be making bold calls about where the likes of inflation and interest rates are heading. We need to focus on building a portfolio that can cope with all sorts of different outcomes. And that means investing and focusing on companies with strong balance sheets, experienced management teams that have the ability to adapt to different conditions while still providing good quality products and services. We also need to remain really disciplined around valuation. It's low valuations that give us that buffer for the unknown happening, and we see that the unknown is happening seemingly increasingly often. So we need to keep focusing on valuation while remaining focused on the underlying fundamentals of the portfolio as well. And we think that Lowland is well placed to deliver long-term capital and income growth from these levels.